Hey everyone, Palo Alto Networks reported fiscal year 2024 second quarter earnings results that disappointed Wall Street investors. The stock was down more than 25% on the day following the announcement. So in this video, I'm going to review those latest results, answer why the stock price is down so much, and let you know if that's a buying opportunity. Of course, going into these results, I did not have Palo Alto Networks stock rated as a buy. I really liked the company. However, the valuation was too expensive for me. So we're going to look at if this stock price decrease is enough of a discount to now make the stock an attractive investment. So without further ado, let's jump right in. And I'm going to start right at the point that caused the stock price to decrease, and then I'll work my way into the quarter's results.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so here it is. Here's what caused the stock price to crash by more than 25%. In my opinion, the primary reason that caused the stock price to crash. And I'm wondering if you noticed it already before I point it out. And it's right here. Total billings. For the third quarter, the company is forecasting that it's going to have total billings increase between 2 and 4% year over year, between 2 and 4%. Remember, total billings eventually turns into revenue for Palo Alto Networks. These are sales that the company contracts, and then eventually they turn into revenue as Palo Alto serves that customer. So let's say it signs a contract for 24 months with a customer, right? That's a total billings. That's a contract. That's a billing that then turns into revenue as Palo Alto serves that customer, as Palo Alto delivers that service that the customer has signed up to purchase. So with total billings growth of just 2 to 4% for the third quarter of 2024, that raises the question, how much is Palo Alto's revenue going to slow down from here? Because the company was growing at roughly 20% or whereabouts, a little bit less than that. But now you're getting way below double digits. You're getting into low single digits growth rate. I mean, this is not good. So that's what had investors really, really concerned here. For the full year, fiscal year, they're going to have 10 to 11% year over year growth. And that was more first half weighted, first and second quarter. Looks like third and fourth quarter is not going to be strong. So that's what had the company down. The rest of the metrics looked solid for the quarter, and I'm going to share those with you now. So for the second quarter of 2024, total billings were 16% up of 2.35 billion. So you could see from the second quarter being up 16% to the third quarter being up only 2 to 3%, that's a sharp slowdown. You can understand why investors are concerned. And this was in near the bottom end of their guidance for the second quarter as well. Total revenue, they hit right at the midpoint of the guidance, increased by 19% year over year to 1.98 billion. So the current quarter, okay, reasonable quarter, solid growth in total billings, solid growth in revenue, but it was that guidance of just 2 to 3 to 4% growth in total billings for the next quarter that has investors really concerned. So their gross profit margin, of course, is excellent, being a services company, 78%. Non-GAAP operating income of 564 million was excellent, up 50% year over year. So phenomenal growth in operating income. If you look at operating income divided by revenue, that's over 25% operating profitability. Of course, this is non-GAAP operating profit margin of 28.6%, which was up 580 basis points year over year. Really strong growth in operating profit margin. The company's delivering solid economies and scale here as revenue is growing. Their profitability and profit margin is increasing. And they told investors they were going to deliver non-GAAP earnings per share of $1.30. They actually delivered $1.46, so much better than they forecasted. Again, I highlighted the current quarter results were solid. If it wasn't for that extremely pessimistic forecast on total billings, the stock price wouldn't have fallen by so much. But It did, and that's why the stock price fell by so much. And let me say that I think it's justified. I think the stock price decline is justified because you're going from a total billings growth rate of mid double digits here from 16% sharply down to 2 to 3%. So it's a big slowdown, and the stock price is valued as if the company's a fast growing company. It's not valued like a slow growing company. The companies that are growing 2 to 4% are trading at valuations in the single digits. They're trading at forward price to earnings of like 6 and 7. They're not trading at forward price to earnings of north of 60 like Palo Alto Networks was. In fact, let me share that with you. So prior to the earnings release, Palo Alto was trading at a forward price to earnings ratio of above 60, a forward PE of over 60. So if you're trading at this premium valuation, you've got to deliver premium results. You can't deliver 2 to 4% growth and be valued at a forward PE of 60. Those two don't match. They don't go together. If you're growing at 2 to 4% and this is a consistent thing, then your stock price is going to be valued in the high single digits, maybe low double digits like 12 if you've got other excellent characteristics going on, but definitely not north of 60 like Palo Alto was. So the valuation needed to adjust based on that guidance, based on that forecast, because that has investors concerned that it's going to be a long-term thing. It's not just one quarter of that. And then finally, adjusted free cash flow, 655 million of adjusted free cash flow on revenue of 1.98 billion. So excellent adjusted free cash flow numbers here from Palo Alto Networks. So like I mentioned, a lot of good things here from the quarter for Palo Alto Networks. Remaining performance obligations, 10.8 billion in remaining performance obligation. These are contracts that it's already signed, that it's going to deliver on, it's going to earn. This is eventually going to turn into revenue. These are existing contracts, not total billings, are new contracts achieved in the quarter. These are what is the cumulative effect of all of those billings, all of those contracts. That was up 22% year over year to 10.8 billion. So it's still in really good shape. It's still in really strong shape. If the company comes in the next quarter after having a hiccup here and slows down in terms of total billings, and then for the fourth quarter revises the guidance and increases back up to double digits in total billings, I think the stock price will adjust back upward by 20%. But as it is, that stock price adjustment was needed because of that significantly slower than expected guidance in billings growth. So to update my recommendation for Palo Alto Networks stock, I had it rated as a hold coming in. I'm keeping it there. I'm not upgrading it. I don't think this stock price decrease is a buying opportunity. I think the stock price decrease because of the decrease in total billings is concerning. So I would wait to hear more from Palo Alto Networks. I would wait to hear more from other cybersecurity companies and see if this is a macroeconomic thing, if all cybersecurity companies are experiencing this, if this is something to be concerned about, or if this is just something Palo Alto specific, if they find that their offering is not as competitive and they're losing market share to competitors. So we need to find out more about Palo Alto before I feel comfortable in recommending this dip as a buying opportunity. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.